Okay, welcome back again. I'm sorry I had to do two videos for these solutions. Maybe it's better that way. I was going through and I looked up at the screen and it told me that I had lost my internet connection. So I am back now and I had to go back and look at how, when that had happened because I'm not looking at the screen, I'm looking at my other laptop and the three or four papers I have here in front of me. So I'm going to pick up with exercise 22, which we have started. Howie Jewelers had the following purchase transactions, journalize all necessary transactions. Explanations are not required. A little bit of an overlap here. So on June 20th, we purchased inventory of $5,100 on account from Sanders Diamonds, a jewelry importer. Terms were 215 net 45 FOB shipping point. So the first two transactions are to record the merchandise inventory being increased by $5,100 with the debit, and accounts payable, the liability accounts payable to Sanders Diamonds for the same amount, $5,100. Since it was FOB shipping point, we have to pay, Howie Jewelers has to pay the freight. So the freight was $400, and it increases the cost of the asset merchandise inventory, and we paid cash to the freight company, or maybe the diamonds might have been shipped via a secured armored car carrier or something. Okay. So on July 4th, and I was saying I'm very un-American here to be doing a return on July 4th when you should be eating cheeseburgers, hot dogs, and setting off fireworks. We returned $600 of inventory to Sanders. So what's happening here? The accounts payable has to be reduced and the merchandise inventory has to be reduced. So the liability gets reduced with a debit, and that would be accounts payable / Sanders Diamonds, or hyphen, not slash. Sanders Diamonds. $600, and the merchandise inventory reduced with a credit of $600. And there's the entry. The liability being reduced by $600 to Sanders Diamonds, and the merchandise inventory being reduced by $600. Okay. So on July 14th, we pay Sanders Diamonds less the return. Well, the terms were $215, and that was on June 20th. So June 30th would have been 10 days. 5 more would have been July 5th. So we are outside the discount period. On July 14th is after July 5th. So no discount earned in this case, even though it was offered. So what do we owe Sanders Diamonds? Just going to make a little T account up here so we can track it. Accounts payable, Sanders Diamonds. We started out owing them $5,100. We returned $600, so we owe them $4,500. Original order, $5,100. We returned $5,100. We returned $6. We still owe them $4,500. No discount taken again. So because we missed the discount period, either we were lackadaisical or we didn't have the cash flow. So now we have to pay them $4,500. So it's a simple reduction of the liability accounts payable to Sanders Diamonds. and a credit to the asset cash for $4,500. July 16th. Purchased inventory of $3,500 on account from Southborough Diamonds, a jewelry importer. Terms were $210 net end of month, FOB destination. Okay, so what do we do here? Merchandise inventory is increasing, so we debit that asset account called merchandise inventory. And we increase the account payable, but this time it's going to be accounts payable hyphen Southborough Diamonds. Different vendor. And that's for $3,500. Okay. Merchandise inventory coming in, asset increase with the debit, liability incurred because we're promising to pay, we're not paying cash. So accounts payable, Southborough Diamonds, $3,500. Received a $300 allowance from Southborough Diamonds for damaged but usable goods. Could somebody please explain to me how you damage a diamond? What did you drop it and it cracked? And it's not a diamond. Artist material known to man and they get damaged. Maybe they drop paint on them or something. All right, so we are going to reduce our liability to Southborough by debiting accounts payable because they're telling us keep the diamonds but take $300 off because of the damage. And we're going to reduce merchandise inventory, the cost only, not the number of units. We're keeping the diamonds or whatever they are, but they're giving us an allowance as an incentive to keep them. So it reduces the cost, but not the units. Nevertheless, we have to do an entry to reduce that liability, accounts payable Southborough Diamonds, with a $300 debit, and reduce the cost of our inventory, but not the units. So we're only reducing, we're doing a credit to an asset account called merchandise inventory for $300, the amount of the allowance. We're keeping whatever we got from that. So on the 24th, it wants us to pay Southborough less the allowance and the discount. Let's see, the discount was $210, so we'd have to July 26th. We're paying on the 24th, so we can take the 2% discount. So let's see how we stand with Southborough. All right, we owe them $3,500. They gave us an allowance of $300, which means we have a net liability to them of $3,200. Accounts payable Saunders, accounts payable Southborough. Original purchase $3,500. They gave us a $300 allowance, so we owe them $3,200. They made that call. So now, what's the discount? 2% within 10 days. Okay, so $3,200 times 2% would be $64, and times 98% would be $3,136. So I took the 3,200 times the 2% to get the discount of 64. Took 98% of that to see what we'd have the net amount of the discount. 2%, 1 minus 2% be 0.98. Those two numbers together would be 3,200. So now all we have to do is write the journal entry to record all that. Our liability to Southborough Diamonds has to be a debit for the amount in that account of 3,200. Okay. Our account shows we owe them $3,200, but they're giving us a discount. They're going to be able to satisfy it with paying only $3,136, but we still have to get that liability out at what it's recorded for. So our payment of cash is going to be 98% of that, or $3,136. And the balancing amount to make the debits and credits equal is $64, the amount of the discount. And what that does effectively is reduce the cost of the merchandise inventory. So we'll credit merchandise inventory for the amount of the discount, because that's how much we're paying for it. Not paying full price. Here's the entry. $3,200 debit to accounts payable to wipe that clean. And we did it by paying only $3,136 to Southborough. And they're giving us a $64 discount for paying within 10 days. And that effectively reduces merchandise inventory account. That does that. And that takes care of that exercise. I think we have one more exercise and then the problem. Okay. Exercise 35. Page down here. Electronic textbook. 34. Go ahead, go 35. Oops. Oh, these things are so sensitive. All right. What do we have here? Computing cost of goods sold in a periodic inventory system. Clink Electric uses the periodic inventory system. Clink reported the following selected amounts as of May 31, 2024. They show us a beginning inventory at a year earlier, June 1st, 2023, $16,000. Merchandise inventory at the end of the current year, May 31, 2024. Purchases discount, purchase returns and allowances, freight in, net sales revenue, common stock, retained earnings. What they want us to do is compute the cost of goods sold. So the cost of goods sold is, I'm going to give you a shortened form here, and then we have to expand on it. Inventory at the beginning of the year plus purchases equal total goods available for sale and then you subtract out the ending inventory, and that equals the cost of goods sold. Simplified version there. Inventory, INV, inventory, subscript BOY, beginning of year, plus the purchases, net. All-inclusive purchases, net. Gives you the total goods available for sale. Subtract out the ending inventory, and the way you determine that is by taking a physical count of what you have on hand, and then subtract that out. And the assumption is the difference is what has been sold. Okay. Now, in reality, we have to expand on that a little bit because that line I have in there, purchases, it is, like I said, a conglomeration of things. So going back to the information they give us, we start with the beginning inventory. And that is $16,000. And now we're going to work on the thing called purchases. Purchases was given as $81,000. And we have to reduce that by returns and allowances. Purchase, returns and allowances. And that was given as $6,600. We also have to reduce that by purchases discounts. Of $3,000. So I got the 81,000 of purchases, but I have to adjust that for the returns and allowances. Also have to adjust it, reduce it for the discounts. That's going to give me a thing called net purchases. Which comes in at $71,400. To that, I have to add in the freight in, because that increases the cost of inventory. $6,000. That will give me what we call the net cost of inventory purchased. Of $77,400. Add that to the beginning inventory, and we get $93,400. And the $16,000 beginning inventory, the net purchases of, the net cost of inventory purchased, $93,400. We'll call that cost of goods available for sale. And that's what we had in the store over the course of the year. The beginning inventory and all the additions to it. Now we'll take out the ending inventory. Of $21,500 still on the shelves or in the stock room. And that leaves us $71,900, and that's the cost of the merchandise inventory we sold or cost of goods sold. Okay. Requirement B, what is the gross profit? Whoops, went too far. Well, gross profit is net sales less cost of goods sold. We just computed the cost of goods sold. They give us net sales revenue of $138,000. This would appear at the top of our multi-step income statement, less the cost of goods sold that we just computed, $71,900. Give us gross profit of $66,100. Now, keep in mind, out of that $66,100 on the multi-step income statement, there's a lot of other things that have to be subtracted out of there. A lot of other operating expenses broken down between selling and general and administrative expenses. And then if there were any other expense or revenue items and income tax to get down to net income. Okay. Now we can tackle the big one, the problem. Okay, what do we got here? Problem 36. Okay, assuming the perpetual inventory system, because they don't tell us otherwise, journalizing purchase and sales transactions. So we have both now. Journalize the following transactions that occurred in September for waterworks. No explanations are needed. Identify each account payable and receivable with the vendor or customer name. Waterwork estimates sales returns at the end of each month. Okay. So, yeah, I was going to say I should run over and get a T account, but I can do it on this line paper. September 3rd. Put September up here, and we have the 3rd. Purchase merchandise inventory on account from Shalin Wholesalers, $5,000. Terms 3/15 net end of month FOB shipping point. So we're getting merchandise inventory. It's going to increase. Just get my lines here to make it look somewhat like a general ledger. Yeah, I went crooked, even with the war. Merchandise inventory is increasing. So we debit it as it is an asset account. And we purchased it on credit, using credit, so accounts payable. And the name of the company that we got it from, Shalin Wholesaler, or Shalin. $5,000. It said it was FOB shipping point, so we have to pay the freight, which happens on the September 4th. So our merchandise inventory gets to the cost of the asset. And we paid the freight company cash, $70. Also on September 4th, we purchased merchandise inventory for cash of $2,400. So the asset merchandise inventory is increasing. And cash is decreasing, so it gets a credit, $2,400. September 6th, we returned $1,200 of inventory from the September 3 purchase. Okay, so now we're at the 6th. So who was that with? Shailen Wholesalers. So the accounts payable has to be reduced with Shailen Wholesalers. And the merchandise inventory account, the asset, has to be reduced because we are returning it. So when we send it back, it reduces the amount we have. And that was for $1,200. September 8th, sold merchandise to Hilton Company, $6,200 on account. Terms $315, net $30, cost of goods sold $28.52. The reason they told us that is we're using the perpetual system. So what do we have to do here? We have to record this, make two entries. One to record the sale, second one to record the change in the inventory. Now, in order to follow or comply with the conservatism principle, we are going to record sales at the net amount because we want to avoid overstating revenues. We will add that back if the customer does not take advantage of the discount we're offering them. We will then pick it up after the discount period expires. So we're selling on account, so it's going to increase our asset called accounts receivable. And we want to identify that it is with Hilton Company. And we're going to have sales revenue being credited. And I'm going to put a little calculation below it. $6,200 less $6,200 times the discount of 3%. Oops. It's 186. So change the sign plus 6,200. $6,014. Okay, so we are selling. Here's the first entry required. Recording the sale. Hilton Company, accounts receivable from Hilton Company, $6,014. Sales revenue, $6,014. What do? We sold $6,200 worth of merchandise to them, and we gave them a 3% discount. So 3% of 6,200 would be 186. So 6,200 minus the 186 is the net amount that we record for the receivable and the sales. Later on, if they don't take the discount, we will recognize the extra income by them not taking the discount. Now we have to do a second entry here. We have to recognize that we've sold merchandise, so merchandise inventory account is being decreased with a credit at its cost, and cost of goods sold is being increased for the cost of the merchandise we sold. So cost of goods sold gets a debit. It's an expense account. normal debit balance. And they told us the amount, the cost was $28.52. So we increased the cost of goods sold with the debit for $28.52 and decreased merchandise inventory by the same amount. Now, we have two entries for one transaction because we're using the perpetual inventory system. The first one is at the retail selling price, the $6,200 less the 3% discount. The second entry, to reduce the inventory and increase the cost of goods sold, is done at the cost we paid for that merchandise, what it cost us. Okay. On the 9th, we purchased merchandise inventory on account from Taylor Wholesalers, $7,000, terms 210, net 30, FOB destination. So let's pick up that addition to merchandise inventory, which will increase merchandise inventory. So we will debit the asset called merchandise inventory. $7,000. And credit a liability called accounts payable to Taylor Wholesalers. Okay. Now, this is a purchase. We're getting merchandise inventory. So we record it at the total amount. If we pay for it within the discount period, we will recognize that at the time of payment. We don't want to prematurely recognize the discount. When we're selling it, it's just the opposite. We want to record it at the discounted amount so we don't overstate sales revenue. And then if the customer does not take advantage of the discount period, we will pick up the additional income at that time. So again, conservative principle, we don't want to overstate revenues, nor do we want to understate expenses. All right, let me scroll down here a little bit. September 10th, made payment to Shaylin Wholesalers for goods purchased on September 3rd, less the return and the discount. All right, so let's figure out how we stand with them. We had an account payable set up with them. It originally had a $5,000 credit into that account. And then we had a return of $1,200. So we currently owe them $3,800. And that is subject to let's see what the terms were on the 3rd. 3% discount if we paid within 15 days. September 3rd plus 15 days would be September 18th. We are doing it on the 10th, so we can take a 3% discount. So I will compute the discount by taking the amount we owe Shaylin Wholesalers, and then I take 97%. It's 1 minus the discount, and that should be the amount of the payment. Those things added together should equal the $3,800. The discount comes out as $114. 3,800 times 0.97 is $36.86 plus 114. $3,800. So I know my numbers are good. Now all I have to do is record that payment. The way I do it, like I said, it checks yourself and it also tells you the amount of the payment you're going to be making. So on the 10th, we are going to satisfy that liability with Shailen Wholesalers, which is for $3,800. But it's only going to cost us $3,686 because we can take the discount of 3% by paying within the 15-day window. I'll show you the partial entry here. That $3,800 in the account payable, the liability account with Shailen. We have to take it out at its full amount, and we satisfy that liability by paying $3,686, and that difference of $114 is the discount on the merchandise inventory, which is going to be used to reduce the amount we have paid for that merchandise inventory. So merchandise inventory being an asset, the reduction in cost is going to be a credit. And there's the entire entry there, and now the debits and credits are equal. All right, I can squeeze one more in on this paper, I think. Let's see what's coming up next. On the 12th, we received a payment from Hilton Company less the discount. All right, so we're getting a payment. And let's go back and look at the details of that transaction. Hilton Company, that was September 8th. We said they could take a 3% discount. We recorded it at the net amount. We sold them $6,200 merchandise. We only recorded it at the net amount of $6,014. We gave them 15 days to pay to get the 3% discount. September 8th plus 15 would be September 23rd. They are paying us well before that on the 12th. So they are entitled to the discount. We already had it recorded at the discounted amount. So all we have to do is pick up the cash with a debit for that amount, and the accounts receivable is going to be reduced with a credit for the same amount. $6,014. I think later on in this problem, we're going to see somebody that we sold to not take the discount. I'm pretty sure, I'm not certain, but I think that's going to happen. Okay, just give me a second here while I draw, make my binder paper look like journal paper by drawing a line down the paper. So we have a debit and credit column. And now we can go to the next transaction. 13th of September. So I'll put the month up the top again and the date here in the left-hand column. After negotiations, we received a $250 allowance from Taylor Wholesalers. Okay, so that's going to reduce the amount we have to pay them. So we're going to reduce that liability accounts payable by that amount. $250. And the effect of that is it's going to reduce the amount we're paying for that shipment, for that merchandise inventory we got from Taylor. So there's our entry for the 13th of September, reducing our liability to tailored wholesalers and reducing the cost of the inventory we purchased from them because we negotiated a $250 allowance. September 15th, we sold merchandise inventory to Julian Company, $3,300 on account, terms end of month. Cost of goods sold, $1,485. Again, with the perpetual inventory system, whenever we have a sale of merchandise inventory, it requires us to do two journal entries. The first one to record the sale, the second one to record the change in inventory. So the sale is going to be for the full amount because we're giving them credit but no discount window. They have to pay us by the end of the month. So we're going to get accounts receivable being increased. And we're going to designate that as being coming from Julian Company for $3,300 with an offsetting credit to sales revenue for $3,300. That's the first of the two entries required. Right after that, in the general ledger, we're going to reduce the merchandise inventory and increase the cost of goods sold. For the amount they told us, $1,485. And again, this makes good sense. Look what we have here. In the first entry of recording the sale, we are getting an asset which appears on our balance sheet. We're also crediting an account called sales revenue, which is a revenue account which appears on the income statement. Okay. The second part of the second entry required when we have a sale is we're reducing the inventory, an asset account that's coming off the balance sheet because we're selling it to the customer. It's going home with the customer. And we're debiting the cost of goods sold, an expense account. So here again, you have a balance sheet account, accounts are in merchandise inventory, and an income statement account, cost of goods sold. In the first entry for that sale, you had a balance sheet account, accounts receivable, an income statement account, sales revenue. The second one, you also have a balance sheet account, merchandise inventory, and an income statement account, cost of goods sold. Now, if you can just think forward a little bit, this amount for sales revenue is going to be shown on the income statement, and this cost of goods sold is also going to be shown on the income statement later on. There's debit here. The difference between that is the gross profit on that particular sale. Let me just scroll down here. Whoops, too far. This thing is so touchy and sensitive. How far did I go up now? Okay. What do we just have? Okay. All right. On the 22nd, let's see what happens. Made a payment less the allowance to tailored wholesalers for goods purchased on September 9th. Well, let's see where we stand with them. September 9th, purchased merchandise from tailored wholesales, $7,000, terms $210, net $30. So that was on the 9th. So 10 days in the discount window would be September 19th. But we're on the 22nd. So we missed the discount period. So all we have to do is pay them for the purchase less the allowance. So the purchase on the 9th was for $7,000. And on the 13th, we negotiated a $250 allowance. So now we owe them $6,750. And here's what it would look like in the accounts payable. The accounts payable, Taylor Wholesalers. There's the original $7,000. The $250 debit reduces how much we owe them because we negotiated the allowance, and that leaves a net amount of $6,750. No discount involved because we're after the 10-day discount period. So we lost 2% by not taking advantage of that. So let's pay them what we owe them. Accounts payable is going to get the debit because we're paying it off. Taylor Wholesalers. And we're going to send them a check for $6,750. So we will credit cash for $6,750. On the 25th of September, let's see what happens. We sold merchandise to Shelton Company for $1,500 on account that costs $660. Terms are 310 net 30 were offered. As a courtesy to Shelton, $7,500 of freight was added to the invoice, for which cash was paid to by Waterworks. So as a favor to the customer, we're going to pay the freight on their behalf and put it on the bill. A little bit of a little twist here. So they're going to owe us money, so we're going to set it up as a receivable in their name, Shelton. And let's see if we can figure this out. $1,500 sale. We want to record the sale net of the discount. And then if they don't take the discount, we'll pick it up at that time when they forfeit it. So $1,500 times 0.97 is $1,455. That's going to be the sale revenue. Oh, excuse me. Oh, excuse me again. All right, so I'm going to bring the sales up. I just computed $1,500 worth of sales, but I'm taking it. I'm going to record it net of the discount of 3%. So that $1,455 is, you can take $1,500 times 3%, subtract that discount amount from the $1,500, or you can take 1 minus the discount of 3%. That would be 0.97 times the $1,500, and you would get $1,455. Now, as a courtesy, we are paying the freight and putting it on the invoice. So we're going to charge them. They're going to reimburse us for the freight. That was $75. So $1,455 plus $75 gives us a total of $1,530. That's what we're going to record as their obligation to us, our receivable. They're going to promise to pay us $1,530. $1,455 is for the sale of the merchandise. The difference, the $75 difference, is for the freight that we put on it, that we paid for them, and we're going to add it to the bill. All right, so now we have to also put in the fact that we paid the freight. So there's the complete entry. the receivable that Shelton owes us, $1,530, of which $1,455 is sales revenue, and $75 was the freight that we paid for them. We paid the freight, so we credit cash $75. Now we have to do the second part of the second entry whenever we have a sale using the perpetual inventory system, and that is to reduce the inventory and increase the cost of goods sold for the sale, the cost of the merchandise we sold. So the cost of goods sold will be debited for the $660, and the merchandise inventory will be reduced with a credit of $660. And there we have it. Again, keeping in mind that these two entries pertain to the same movement of goods. One is at the retail selling price, the top one where we're recording the sale. The bottom one with the cost of goods sold and the reduction to the merchandise inventory is done at the cost we paid for those items. Okay. One transaction, two different values. Our cost of acquiring that inventory and the retail selling price of that inventory. Okay, on the 29th, we received a payment from Shelton, less a discount. So let's see, $310. They paid us within 4 days. They're within the 10-day discount window, so we're going to not have to have a entry to pick up the forfeited discount. So we are getting cash of $1,530, $1,455 for the merchandise we sold them, and $75 for the freight we paid on their behalf and added it to the invoice. Straightforward, simple entry, picking up the cash with the debit to cash and reducing or recognizing the fact that they made good on their promise to pay us $1,530 by reducing the accounts receivable with a credit. And finally, on the 30th, we received payment from Julian Company. That was a sale on the 15th. Sold merchandise to Julian for $3,300 on account. Terms net end of month. The cost of goods sold was $1,485. We recorded that when we sold the merchandise, so now we're getting the payment. So once again, we are going to pick up the cash of $3,300 with a debit, and we're going to reduce the accounts receivable. They promised to pay us, and they did, so they've made good on their promise. So we cancel that out. $3,300. Okay, there it is there. Oops, sorry, moving it around because I'm holding it with one hand. Okay, is there anything else we had to do there? I don't know. Let's see. I think that's all we wanted. Yep. All right, that was a very exhaustive problem, but it's a good experience. And again, I'm sorry that the internet went down and I had to break the video up. But maybe it's better off you have two that run around 40, 50 minutes instead of one that runs an hour and a half, hour 45 after 6 lectures. Oh, no, we're having an exam coming up. So I'll be watching your emails for the exam. Thank you.